Shopify's story in 2025 is one of maturation, reinvention, and a new phase of strategic partnerships that could change how online commerce actually happens. In the quarter that ended on June 30th, 2025, the company reported total revenue of approximately $2,680 million, representing year-over-year growth of 31%. And it posted a free cash flow margin of about 16%, which management said marked the 8th consecutive quarter with double-digit free cash flow margins. These results matter because they show Shopify moving from a pure growth narrative towards sustainable, cash-generative growth while continuing to scale services beyond simple subscription fees. Behind those top-line numbers, the business mix is important. Subscription revenue in that quarter was roughly $656 million, growing at a mid to high single-digit rate, while Merchant Solutions revenue, which includes payments, fulfillment, and advertising, expanded to just over $2 billion and grew at a much faster pace. That divergence is central to the investment thesis because subscription revenue provides stability and a predictable base, while Merchant Solutions carry higher take rates and the potential for margin expansion as these services gain scale. Together, they turn Shopify from a shopfront provider into a commerce monetization engine for merchants. Shopify's aggregate commerce volume continues to be meaningful. Gross merchandise volume for the trailing quarter was reported in the tens of billions of dollars range, with particularly strong growth in some international regions. Management highlighted that merchant adoption of higher margin services and the broader product roadmap are driving improved unit economics, which is why free cash flow margins and operating income have become almost as important as headline revenue growth for investors evaluating the company today. The cash generation gives management optionality to reinvest in product, do strategic tuck-in acquisitions, or return capital to shareholders should they choose that path. The macro and competitive backdrop remains an active risk. Evolving consumer behavior, advertising budget cycling, and intensified competition from marketplaces and commerce platforms mean that merchant volumes could be lumpy. The company has also executed workforce reductions in prior periods as it rebalances investments and aligns resources to strategic priorities, which can create short-term headline risk even if the long-term economics improve. Investors should treat workforce actions as a symptom rather than the full story, and focus instead on merchant retention trends, take rate dynamics for payments and services, and the trajectory of recurring revenue. A major new variable in Shopify's 2025 outlook is its partnership with OpenAI, and the broader move to bring commerce directly into conversational AI. In late September 2025, OpenAI announced an instant checkout capability that allows users to complete purchases within ChatGPT conversations. And OpenAI confirmed partnerships that include Etsy and Shopify, with plans to expand the capability to many Shopify merchants over time. This integration promises frictionless, link-free commerce experiences where discovery, recommendation, and payment can happen inside the AI interface itself. If broadly adopted, this could meaningfully lower conversion friction for small merchants and create a new distribution channel for Shopify sellers. From a strategic perspective, the OpenAI tie-in amplifies several elements of Shopify's existing competitive advantages. First, it leverages Shopify's merchant base and fulfillment and payments plumbing so that when conversational AI surfaces a product, the buyer can complete the purchase without being bounced across sites or payment providers. Second, it potentially increases discovery for Shopify merchants because AI agents can recommend items contextually at the moment of intent. Third, the partnership could produce data feedback loops that improve product discovery and personalization for merchants who participate. All of these dynamics, if realized at scale, increase merchant lifetime value and raise the strategic value of Shopify's ecosystem to developers and partners. Shopify's own announcement about bringing commerce to ChatGPT emphasized the seamless, link-free experience for merchants as a core benefit. That said, there are important caveats. The OpenAI integration is nascent, and today's implementations focus on single-item purchases in the United States, with plans to broaden functionality over time. Monetization mechanics, merchant economics, commission structures, and the ultimate user experience will all affect whether this channel becomes a significant revenue driver or remains an interesting but marginal convenience for certain categories and audiences. Moreover, the expansion of agentic commerce raises regulatory and privacy questions that could influence how quickly and widely these features roll out. Investors should watch adoption metrics and any merchant feedback Shopify publishes about take rates and conversion performance through the ChatGPT checkout experience. Turning to valuation and scenario planning, the more favorable financial profile in 2025 means traditional multiples are now more informative than they were when Shopify was a high-growth revenue-negative company. That said, the current valuation embeds expectations of continued double-digit revenue growth and further margin improvement as services scale. An optimistic scenario is one where merchant solutions continue to outgrow subscription revenue. OpenAI and other distribution partnerships unlock incremental GMV without major margin leakage, and the company compounds free cash flow at attractive rates. That path supports a re-rating and strong capital appreciation. A base case moderates growth into healthy but lower double-digit territory with steady free cash flow conversion, producing returns more in line with growth software peers. A downside case sees merchant volumes decelerate, competitive pressure compress take rates, and the valuation reset toward lower multiples. Investors should model all three and size positions accordingly. From a technical and market microstructure perspective, Shopify's stock has been volatile, reacting strongly to earnings, macro headlines, and strategic announcements. Short-term traders will find clear catalyst windows around quarterly reports, product launches timed to the holiday shopping calendar, and partnership rollouts like the OpenAI checkout. Longer-term investors should be less reactive to daily swings and instead monitor quarterly disclosures for durable improvement in merchant retention, take rate progression, and operating leverage. In practice, that means watching monthly recurring revenue trends, payments take rate trends, and the cadence of merchant services adoption as leading indicators of durable earnings power. My recommendation is conditional and time horizon sensitive. For investors with a multi-year horizon who can tolerate meaningful volatility, Shopify is a buy because the company combines a large and growing commerce footprint, improving profitability, and new optionality from AI distribution partnerships. The OpenAI integration is strategically exciting and could materially expand merchant reach if adoption scales, which adds to the long-term upside case. For more conservative or near-term oriented investors, wait for additional confirmation. Sustainable margin expansion across multiple quarters, clear metrics showing the economic impact of new distribution channels like ChatGPT, or a valuation reset that provides a wider margin of safety. Regardless of which path you choose, size your position so a single company does not dominate portfolio risk, and set clear monitoring triggers tied to merchant metrics and cash flow. In closing, Shopify in 2025 is an evolutionary story rather than a single event. The company now shows meaningful revenue scale, recurring subscription stability, rapidly growing merchant solutions revenue, and positive free cash flow margins. The new OpenAI commerce integration opens a potentially transformational channel that could increase discovery and lower friction for shoppers, while routing more transactions through Shopify's payments and fulfillment rails. That combination creates asymmetric upside for long-term investors who believe in the platform, but it also introduces execution and regulatory risks that should be monitored closely. If you're buying, do so with a multi-year horizon, disciplined sizing, and quarterly thesis checks. If you found this deep dive useful, please like the video and subscribe for weekly research and data-driven breakdowns. Hit the bell to get notified when we publish scenario models and a 3-year projection you can use to size a position. Thanks for watching, and see you in the next one.